From New York City for our viewers worldwide, I'm Matt Miller. We are waiting for some important Tesla numbers. Markets are down right now. The countdown to the open starts right now. Futures losing steam as investors await Friday's jobs numbers. We'll see those from the beach. Central bank leaders try to manage the message at a gathering in Sintra, Portugal, and Tesla deliveries expected to slump yet again amid a price war in China. But we begin with the big issue, concerns shifting from inflation to the labor market.
In the Fed's dual mandate, we've been doing great on the employment side, and we have done far less great on the inflation side. But now inflation is coming down, so we got to think about both sides. Usually, as they describe, unemployment goes up like a rocket and comes down like a feather. And so that's on everyone's mind, that there are some warning signs in the job market. The job market is still quite strong. It's just been some warning signs.
Joining me around the table now, Brian Levitt, Invesco Global Market Strategist, and Amy Wu Silverman, RBC Capital Markets Head of Derivatives Strategy. And there is a lot to talk about. It's not a slow summer. It's not a slow holiday week. Let's talk first about the Fed. We're going to hear from Jay Powell with Christine Lagarde in just a moment out of Sintra. Brian, what do you think about the Fed's job so far and where we're headed?
So the Fed has done a good job so far, but they're at risk of getting behind. They're very data dependent. I want them to be looking forward. And I agree with what Austin Goolsbee was saying, and it's comforting to hear Austin Goolsbee say, I think the inflation story is passé. Right? If you look at the core personal consumption expenditure, we're in the Fed's comfort zone, right? And yet 5.25 to 5.5 target Fed funds rate is too tight for a 2.6, 2.7% inflation world. He's right. The job market is starting to slow. Let's get on with the process. Let's get out in front of the economic slowdown and start easing policy.
Right. He's pointing out that, as inflation comes down, holding pat on rates is actually like tightening, which makes a lot of sense. Amy, what are you seeing around the Fed? What kind of bets are investors placing?
Look, people are busy placing bets, but they're all through zero-date expiry options. They're quite busy doing that. If you look at the volumes, they're quite historic. But overall sentiment, look, in the volatility world is still pretty sanguine. You still have a 13 handle on the VIX, 7 points below our 30-year average, which would tell you that sentiment is still not there in terms of worry. But I do think things are shifting a little bit. All
right, we have got breaking news on Tesla. Second quarter deliveries are out at 443,956. That's a little bit better than the estimate, which was for 439,302. It's still a drop, but we are seeing Tesla come out with deliveries that are lower, and we're going to talk about that in just a little bit. We're going to go out to San Francisco, talk to Ed Ludlow, host of Bloomberg Technology, about this. So keep an eye on Tesla in the pre-market, and of course we'll watch to see. It wasn't unexpected, right? We were looking for a more than 5% drop. So we do see Tesla out with second quarter deliveries a little bit better than the estimate, and in the pre-market, those shares are up a little bit. Let's get to the economic data that we're expecting out in less than an hour. It is the JOLTS numbers. Michael McKee, Bloomberg's chief economics and policy correspondent, is standing by. So, Mike, what are we expecting?
Well, Matt, the story is sort of, as Austin Goolsbee outlined it, a question of how fast is the labor market slowing. We got one clue coming up at 10 o'clock with the JOLTS numbers, the job opening and labor turnover. How many job openings are out there? We've had an extended high level of job openings, and when that happens, of course, the unemployment rate is low. Now unemployment's starting to go up, and job openings are starting to come down. And the question is, if we get the number forecast, about 7,950,000, do we then see us get back to the level we were at before the pandemic? And if that's the case, the Fed will know that things are going okay because they've been focused on JOLTS as a way of telling how tight the labor market is. This would suggest at least some loosening. Then we go to Friday, and the jobs report. Now, the real question is not the total number of jobs created, which, by the way, in the last 30 minutes dropped to 198,000, so I'm not exactly correct with the chart, but the unemployment rate, 4%. Does that continue to rise? It rose a little more than expected last month, and now we're waiting to see if that continues because, of course, there's something called the SOM rule. The SOM rule posits that 3-month moving average of unemployment, when it rises a half percentage point over the 3-month average low of the past year, you are in recession. We're getting close. You can see down there in the lower right-hand corner, very close to that level. And as you can see from the chart, every time we hit that level before, we went into recession or we're in recession. Now, Claudia Sahm thinks herself, she was on Bloomberg TV this morning, that maybe it's not that bad because we are seeing a big jump in the labor force with immigration, but immigration has tailed off. So do we start to see real problems with unemployment, and does that force the Fed to move? Those are the questions Austin Goolsbee is asking, and those are the questions some of this data will help answer.
All right, Mike, thanks very much. Michael McKee there talking to us about the JOLTS number that we're going to expect and how the Fed views things. Amy Wu Silverman here from RBC. And, you know, it's interesting. Mickey Bowman, I think last week, was talking about the fact that we're seeing some restriction on immigration. The Biden administration trying at the very end of the term, right before the election, of course. And Trump, if he wins, is expected to be very restrictive. Does that tighten supply, do you think, on the labor market? Do you see people putting bets around that?
It's a great question. And it's funny because I will tell you, up until now, up until the presidential debate, we haven't really seen that many bets in the options market. That really is starting to change. And it's not just because, you know, the predicted bets are really overwhelmingly swinging one way. I think people are basically asking me where the shocks to the volatility have been in history and where we can go in the future. And, you know, I can tell you that VIX can go to 35. It can go to 40 from the 13 hand levels. So people are looking at VIX calls. People are looking at downside. It is very election related because of the policies that Trump has talked about. And obviously, post the presidential debate, the betting market's essentially saying that he has a higher probability of winning.
That's really what I was clumsily trying to get at, is that there's a lot of volatility around these elections, right? I mean, some people come on and say, especially, you know, equity strategists, it doesn't matter. On the other hand, you've got some pretty dramatic results out of France. You have the election coming up
Absolutely.
in the UK, and here in the US, I think maybe opinions change quickly after people watch that debate. Brian, what do you think about the importance of the election? Does it matter to this rally, for example, that we've seen in stocks?
I don't think it matters to this particular rally. I think the Federal Reserve is far more important to this. The thing that I try and do, and it's my job to try and help ease investors' concerns around the country, at least keep them sticking to a plan. And every 4 years, election concerns come up. And some of the things, Matt, that I've been trying to tell them is, look, people were very worried when Trump won in 2016. The market was up 60% under Trump. People were very worried when Biden won in 2020, probably the opposite people. And the market's up 71% under Biden. It was up 200% under Reagan, 200% under Obama. So it doesn't matter in the broad, you know, in the aggregate as much as people think. Since 1957, there's only been 2 times where a presidential administration ended with negative returns in the market, and that was Richard Nixon, whose term didn't finish, and George W. Bush, whose term ended in a great recession. So I do think it's overplayed from the perspective of investors watching us today. Don't allow this to, you know, to freak you out of your positioning. The markets have done well historically under all parties, most presidents.
But you can trade around it. Certainly in the options market, you can trade around elections, right? Amy, you can trade around new debt numbers and deficits that are just seemingly out of control, even though strategists will say it doesn't really matter right now. I talked to Ed Hyman, and he says, you know, if the 10-year doesn't care and if the dollar doesn't care, I don't really care that much. But what does the options market say?
Look, you know, all it comes down to me is tenor. So it's really quite simple. I actually agree with Brian on a longer term basis. That is true. But the actual nuance, I think, to the volatility markets is if there isn't clarity about who the winner is. And I think that is a tail concern that seemed very, very low probability, but now is a little bit more high probability now. And the issue is when it's not clear who the presumptive candidates are, then you do get volatility. You get a for instance, a year 2000 where it wasn't clear, your VIX spiked dramatically. And again, it comes down to tenor. Do I agree that on a 1 to 5 year basis, this is something we can look through? Sure. A lot of the investors we speak to, they're more 1 week to 3 month. And that tenor difference, I think, is where you start to trade around that. And we do see folks doing that because it is less clear now than it was before who the presumptive candidates are.
And I agree with that. What's interesting, though, and it's hard to figure, when you look at any time that volatility has spiked during election periods, it's been associated with a recession, whether it is 2000 or whether it is 2008. If you look at most other election periods, volatility has not increased. If they're not associated with recessions, then they don't increase. But I do agree policy uncertainty creates volatility. That's where it always comes from. And I'm more concerned about policy uncertainty with the Federal Reserve at this moment. I mean, to me, we probably know who the candidates are. I think that's our base case. And if we don't, I can't imagine significant changes from a policy platform perspective.
I mean, both of you, I think long-term would agree that it's about the earnings. It's about the economy, right? And that's why the Fed is important. If you take a look at the Atlanta Fed GDP now picture, it doesn't look very bright, right? They predict a continued drop in GDP growth, even though we've had this earnings expansion. It's been driven mostly by the Magnificent Seven, right? The 493 haven't caught up yet.
Right.
Do you expect that to change?
Well, we would need a catalyst for that to change. And so, the catalyst would need to come from a shift in the policy environment. We need to normalize the yield curve and work to reinvigorate economic activity now that we're clearly slowing. And so, if you look at signs, are we heading into a recession? Do we have corporate bond spreads blowing out? Do we have bankers tightening lending standards? No. But tactically, it's an economy that's slowing, and the longer we sit here with tight policy and an inverted yield curve, the higher probability we get of a policy mistake. I'm not there yet, but I would like to see the Fed move. They just don't answer my phone calls.
Well, maybe they'll listen to this program. Amy, what do you think of the market? It's so sanguine, right? As you mentioned a few times, the VIX is so low. We can climb on the S&P with no breath at all. I've seen a couple of days this year already with 112, 113 winners, and yet we're up. Only 10 companies make up 35% of the total index and 23% of earnings. Does this lack of breadth look worrisome?
It is actually very worrisome to our investor base, and it sort of just comes down to the math. So I'll give a simple example. The days where you see small cap do well or you see breadth widen, the overall market is actually down because it's actually more of a function of the weight of the heavy mega caps. And so what we're actually seeing investors be selective about is saying, okay, I'm going to hedge, but I'm just going to use the Mag 7 as my hedge because essentially it's a proxy to the overall market anyway. And we're at a period where implied and realized correlation has just never been this sustainably low. And what happens when correlation picks up? Volatility rises, the market goes down. And to me, it's if tech goes, the market goes. We watch sentiment on those 7 names unbelievably closely, and those have not been that great. People want to hedge those names. People are more looking for protection on those names than they were, say, 3 months ago.
When is it time to rotate out of when do you take profits from the money you've made on NVIDIA and say, I'm putting it all on the Russell 2000?
And the interesting thing is right now we're slowing, and slowing means you tend to want to be in the more mega cap, high quality
It's kind of defensive.
names. Yeah, it's sort of like a heads we win, tails we win right now with the mega. So I hate to keep putting it on the Fed or the shift in the environment, but you would need the catalyst for that. Usually, we saw it, Matt, right, in November and December of last year. The market priced in 6 rate cuts, and yet a bull market in small caps in a couple of days, not a couple of days, but you know what I mean. And so you see what that can look like, and we've spent this year pricing out the rate cuts. So we've gone back to the mega high quality because the market thought Fed was too tight and we're going to slow down here, which of course is happening. So you'll need the catalyst, the next shift in policy, hopefully without a recession. But even if it is a recession, the recovery out of that will be more cyclical, more small, more value-oriented. So, hopefully we recover from a slowdown. If not, a recession, either one of those will likely broaden out the markets.
All right, thanks to both of you for joining us. Amy Wu Silverman of RBC Capital Markets, Brian Levitt of Invesco. We're going to take a look right now at some of the individual stocks moving ahead of the opening bell. Just 15 minutes to go. For that, we go over to Abigail Doolittle. Abby, what do you have?
Lots of interesting stories and moves for stocks this morning, Matt. Let's start off with the shares of Tesla because they're at more than 4% on that delivery for the second quarter number coming in better than expected. Close to 440,000 EVs were delivered relative to the estimate of closer to 439,000. The sentiment has been so low for Tesla. The shares really outperforming over the last 2 days, up about 10% if this gain holds. Technically, the chart is now setting up for a big move higher toward last year's highs. On the other hand, NVIDIA is doing exactly the opposite, is down more than 1% in the pre-market. That chart setting up for a big breakdown to the downside, potentially to go sub 100 if below about 118. And that simply represents buyers who bought well or below 100 on a split adjusted basis, wanting to take profits over time so as to not adjust their profit base. GameStop down 1.4%. That lawsuit we were talking about yesterday, there was an investor who sued Keith Gill for the fraud, the Roaring Kitty fraud suit, basically saying that he committed securities fraud of some sort in terms of his quote-unquote pump and dump GameStop scheme. That has now been dropped. It's really interesting, Matt, because the spirit of the law maybe was stretched there, but it was clear that no law was broken by posting memes on social media. It almost seems as though there was some sort of desire to create a bad sense around Keith Gill. And then finally, Paramount up 3.5%. Barry Diller perhaps entering into the race to explore a bid for Paramount. Yet another story there. This keeps on giving.
All right, so the allegation of frauds rescinded there. Very interesting stuff. Abigail Doolittle with a little technical analysis as well. We got to get those charts, Abby. Coming up, Tesla deliveries beat expectations. We'll take a look at the EV giant next. It's selling all threes and Ys. No X's and S's. This is Bloomberg. Tesla second quarter deliveries came in above expectations. The EV giant revealing the numbers just moments ago. Joining us now is Bloomberg Technology co-host Ed Ludlow out of San Francisco. So Ed, beating by what, 3, 4, 5,000 in terms of deliveries. What's the story?
Yeah, it's a beat and some relief in the stock relative to street expectations. It's important to note that even though deliveries beat, it's still a decline year on year of about 5%, I think 4.8%. And you could also look at the production level being markedly lower than in the same quarter a year ago. What I find really interesting, Matt, is that I was in New York City for the first quarter numbers, you might remember, where the release had so much detail about the factors that were impacting Tesla in the first 3 months of the year. But in this release for the second 3-month period, there is no commentary at all, which is interesting. You know, it's a considered omission. But we did hear quite a lot from Elon Musk on the last earnings call, of course, about the factors that are impacting both demand but also operationally and supply right now.
I haven't, looked into the detail in a long time, Ed. And of course, you cover this company very closely. But to me, it was surprising that almost all of the vehicles they sold were Model 3 and Model Y. Do they not even sell the S and the X anymore? I mean, it looks like, what, 20,000 of those more expensive models, and the other 420,000 were 3 and Y?
Yeah, I mean, Elon Musk and other Tesla executives have been honest that they largely still make the S and X for sentimental reasons. It is not a volume product. You know, the plaid version, the rethink that they did in the latest generation, it's an expensive and premium product. And there's equal surprise when those less familiar with Tesla also hear the Model Y is technically the best-selling vehicle model in the world.
In the world. That bears repeating,
right.
Ed, because I did not know that, and I look at cars all the time. So is it, I mean, I would expect the Toyota Camry, the Ford F-150, like the Honda Civic. The Model Y outsells all of those other single models.
It does, and those other examples you noted, well, I would say with Model Y is its uniformity across different geographies. It sells well in the United States, China, and in continental Europe as it stands, where, you know, as you know from experience, there's a bias towards smaller form factor vehicles. I'd also say let's look at what's happening in the China market specifically, because we also got data from China's Passenger Car Association, which showed in the month of June, not the full second quarter, but June, a pretty significant drop in output from the Shanghai factory and also deliveries domestically. And so Tesla is not doing so well in China at this moment in time, but those domestic players, NIO, Li Auto, etc., they're pushing new records. BYD, of course, did very well. And one of those factors that Elon Musk talked about, apart from domestic competition in China, is this admission that Tesla is now directly competing with hybrids, that consumers, when faced with a choice right now in different markets, are opting for hybrids, which I find is really interesting because we've changed our psychology about EV buying in the market completely from, say, a year ago.
Well, I've always thought hybrids are the way forward. It just gives you more optionality as a driver. In terms of, you know, product, Ed, you know, the Cybertruck, as exciting as it may be, they're not selling that in volume. As you said, the Model S and the Model X are just kept around for sentimental reasons, also not big sellers. So it's all about the 3 and the Y, and they still have had a decline in sales. I mean, sales are down 5% year over year. That's not great for a company that wants to be a growth story. What else do they have in the pipeline?
And also noting, I just reiterate, the production is also, you know, down relatively significantly to the same period a year ago. A lot of the sell-siders, for what it's worth, basically say that the lineup is stale if you strip out Cybertruck, which is still ramping. You know, Model Y is the best-selling product model in the world, but it's now relatively old. There's not been a refresh or a new model. Of course, on August 8th, we will get a glimpse of Robotaxi, and during Investor Day, you see the PowerPoints with yet to be unveiled models under canvas. So there's a belief that new models are coming. My own reporting is that they will take the work they did on a $25,000 EV and apply the R&D, the technology breakthroughs, to refreshing the Model Y and Model 3 in particular, lower spec, maybe single motor variants. But that's the argument that industry analysts make, that Tesla would do well if they introduce more models at a more regular cadence.
All right, Ed, great to get your take on this company. Bloomberg Technology co-host Ed Ludlow. Catch his program coming up at 11. Next here, we're going to give you the morning calls. This is Bloomberg. Time now for the morning calls. Look at some of the analyst recommendations on Wall Street this morning. First up, Susquehanna raising its recommendation on PayPal to positive. The analyst is confident the company will make profitable growth a top priority. Next up, Piper Sandler is downgrading CrowdStrike to a neutral. That analyst cites valuation concerns for the security software company. And finally, Citi and Raymond are downgrading Raymond James, downgrading Lennard to hold equivalence. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. We are moments away from the start of trading. You can see futures are down on the S&P and the NASDAQ. Small caps are gaining right now as we await the opening bell at the New York Stock Exchange and the NASDAQ market site. We are also expecting Jerome Powell, Fed Chair, to speak at Sintra in just a few minutes, and we're going to take that live for you. He's going to be speaking with a couple of other central bankers as well. Here you see some of the other assets that we're watching. 107.36. Christine Lagarde is going to be one of the other central bankers on the panel with Powell. We really haven't seen the euro move out of this range. I mean, for a couple of sessions, it dropped down to 106 after Macron called a snap election in France. And for a while before that, it was up around 108 and change. But it's really been hovering here with very little movement. The 10-year yield as well holding steady at 442 right now, just off about 3 3/4 basis points. And then NYMEX crude actually continuing its upward march. So now 83.89 a barrel for NYMEX. Let's get a look at some of the other stocks moving at the start of of trading. For that, we go right over here to Abigail Doolittle. Abby, what do you have?
Well, we do have lots of stocks on the move here, Matt. Let's start off with the shares of Tesla, because right now they are up over the last 2 days 11%. So a very, very nice rally. That's the best rally going back to the end of April. And today's rally, with the stock up more than 5%, this has to do with better than feared second quarter EV delivery numbers. That estimate, or that number, came in at 440,000 versus the estimate of a little less than 440,000. I think the sentiment was so bad. That's why we have this stock up. And on this, the shares of Tesla are very close to putting in a breakout. There's a long-term downtrend that has capped the shares of Tesla. That may happen again because the daily RSI, or momentum indicator, which is not shown in this chart, it is a little bit peaked out, Matt. But on the other hand, the stock is back above its 200-day moving average. And it seems to me as though there could be some kind of a funding rotation going on within big tech, because on the other hand, we have the shares of Nvidia down deeply in a correction. In fact, actually close to a bear market today, down 2% for no particular reason. If we take a look at this chart, Matt, I would argue that it has everything to do with people who bought very well below $100 per share on a split adjusted basis. And rather than wanting to disrupt their profit, they're taking their time. And so the sideways trend that we've had since the last quarter, that has gone, let's call it between 100 and the recent high. That is, again, some of those people who bought very well, taking some profits, but not taking it all at once. So to not disrupt their profit taking, the profit that they could make. But if below 118, Matt, we could see a pretty quick drop back down toward the gap pre-earnings for the last quarter that was reported. And that is closer to, let's call it $90, somewhere above $90.
All right, that's, interesting technical. Look at the technicals there, Abigail. I would go back to the Tesla chart, and the interesting thing to me is the market cap, right? Tesla is a $700 billion company. Ford is worth $50 billion. GM is worth $50 billion. Volkswagen is worth $50 billion. This is a $700 billion company that just posted a 5% drop in sales. How does that make any sense at all?
Well, I think that goes back to the question of whether or not Tesla is a technology company or a car company. So I think that it's probably a blend of both. And I think that that market cap reflects its mega cap tech status, and that they're being given a little bit of a breather for that sales drop. Wall Street's all about estimates. It's about perception. So relative to the second quarter EV numbers, what have you done for me lately? They beat. So I think investors are rewarding the shares for that reason. Plus, it was down so much, as that chart showed, that strong downtrend down this year when the other mega caps are higher. I think that that's another reason that we're seeing a bit of a catch-up trade here.
I like to look at, on the Bloomberg GF, graph fundamentals. I was just looking at it for the car makers and noticing that GM sales are up, Ford sales are up, right? Even though they're only worth, a fraction of Tesla. If I look at that for Nvidia, the sales is just up and to the right. It's difficult to predict where they're going to go. Okay, a great look at a couple of stocks. Abby, thanks very much.